Hello there, SCR Kickstarter folks. I am really excited tonight to have with me the amazing Amanda Han. Those of you who, I guess, I'm probably dating myself at this point, but if you were ever on Bigger Pockets, she is the author of the two books published by Bigger Pockets on taxes, and definitely the two books that I would say got me excited about taxes and real estate and all of that. So it's really an honor and a pleasure to have her on tonight. Welcome, Amanda.
Yeah, thank you so much for having me. I love hearing that our book got you excited about taxes
Oh yeah.
because excitement and taxes rarely appear in the same sentence. So I just love that you started out with that, with those two words together.
I still remember where I was sitting when I read the first book. I think I was on a
Uh-huh.
flight and I was reading through the first book and I was like, oh, okay. So now my flights can be tax deductible. Okay, so now this can be tax deductible. And it was really fun to now just like see like real estate investing as a way to ultimately, have some kind of tax strategy, which is something that I had never really like spent the time to learn. Now let's talk a little bit about you. When did you get into real estate investing and or accounting for her investors?
Yeah, it's really interesting. So I started out my career like many people, which is like go to a good college, get a steady job. And I was really fortunate after college that my first job was at one of the big four accounting firms. And so for those of you who are in the accounting profession at all, like kind of the ultimate dream of an accounting major is to go into one of those four firms. And I just happened to end up in the real estate group, which means like my clients were, just like very large investment firms and large developers and things like that. But I never thought I would invest in real estate myself. I was just an accountant, I was like counting money for other people. And it wasn't until my husband actually read Robert Kiyosaki's Rich Dad Poor Dad. And you talk about remembering where you were when you read my
Yeah.
book. I remember when we read Kiyosaki's book, we were in bed and my husband said, we need to buy a rental this year. And I was like, you must be crazy. Because, rental real estate was for like our clients who are
Right.
super rich, millionaires and billionaires, not for Amanda and Matt. Um, so that was kind of my first exposure, like, hey, maybe this is something we can do. And so over time, we, got into real estate investing ourselves. And that's when going to like local real estate meetups and just different real estate boot camps, and we started to realize that like all the strategies we work with investors on at work
Mhm.
was actually not known or available to everyday investors.
Hmm.
And that's what kind of prompted us to start our own firm at Keystone CPA, where we basically take some of those same strategies that are used by super wealthy people and modify it so that everyday investors can get a benefit from it.
Amazing, amazing. And I mean, I really think you've done that because with all your work, I remember like back then, before your book came out, it was between you and Brandon Hall at the time that any tax related post, people would tag you. This is like, I don't know, it sounds like donkey years now, but like circa 2016. Um, and then so when you wrote the book, it was like, yes, okay, finally, in one place, you can literally just open a book and just read and have like a good grasp of all of this. That, yeah, you're definitely doing the Lord's work. I'm just gonna put it out there, okay? um,
It's really funny because my husband and I were actually on a cruise,
mhm.
and being the tax nerds we brought a bunch of tax books with us. So they're books written by other CPAs
Yeah.
about like how to save on taxes. And I for me, even as a CPA, I got super bored reading those books. And that was actually the start of my idea to write a book. I was like, you know what? If I as a CPA cannot enjoy reading a tax book, then how can we expect an investor who's not an accountant, not
Right.
in accounting at all, to understand what the heck we're talking about?
Yeah.
And so I was like, I have so many good and bad client stories to share. So I'm like, I want
Mhm.
to put that in a book, and then, kind of like a chicken soup for the soul, but I don't know, tax soup.
Yeah, yeah. No, no, seriously, that book has, I mean, it just distilled it down into like, okay, you can read, you can understand taxes. Like it's not like this, like it's like the jargon is not there. I mean, of course, there are words that you have to use or whatever, but yeah, like I said, I still remember. So now, um, let's talk about short-term rentals, okay? Or yeah, I guess we should probably just get right into that. Now, actually, you know what? Let's talk about your story about real estate investors versus other people in terms of how much you were seeing them save. Because I think I've heard you talk about that a little bit elsewhere. What are the advantages for somebody investing in real estate from a tax standpoint? This is just real estate in general.
Yeah. As real estate investors, regardless of whether we are doing, short-term rentals, long-term rental, and now there's, midterm rentals popping up all the time. As investors, we all get to take some of the same advantages that the tax law offers us. And so, we start with like, hey, if you're someone who's just always historically made W-2 income, you probably already know, or your CPA's told you that you really don't have any write-offs,
Yeah.
right? There's not
Yeah.
much. You can contribute to your 401k, put some money in the health savings account, IRA, that's pretty much it. And so, as a real estate investor, it's really important to understand that we are business owners in the eyes of the IRS. And by
Mm.
business owner, I don't mean like you have an LLC or corporation. I just mean you're in the business of owning rental real estate. And so, as business owners, now we get into a whole new world where we can have business write offs, like you were mentioning, right? I'm traveling to my rental properties, I'm traveling to a real estate conference. Those are no longer personal expenses, they become business expenses, which we can use to reduce the income that we earn from our rental properties. And this is the true regardless of what type of rental real estate you invest in.
Mm. Okay. Okay.
And of course,
Yeah.
beyond like deductions, all real estate investors get to take advantage of depreciation.
Yes.
So that's simply just IRS saying, hey, your property is going to have wear and tear over time. And so I'm going to have a set of laws that allow you to write off part of that wear and tear every single year. And this is true regardless of whether your property is actually appreciating in value or
Mhm.
not. So that's what I love about real estate. It's like real estate appreciates, but tax law says we can depreciate it
Appreciate it.
and save
Yeah.
some money.
Yeah. That was one concept that definitely won my heart. When I first kind of delved into real estate, it was like, wait, what? So I can make this money on the side, and then there's this magic number called depreciation that just makes it just go poof. Okay.
Yeah.
Sign me up. Let's just make money go poof. But now we now know that with short-term rentals, there is an extra advantage for those people who are working either full-time or may not qualify as real estate professionals. Can you kind of go into that a little bit?
Yeah, for sure. So, for those who invest in long-term rental properties and you are of higher income, so for this purpose, we're talking about someone who makes over $150,000.
Mhm.
And so if you make over 150,000 and you invest in rental real estate on the side, meaning you have a W-2 job still, odds are that any losses that you strategically create from your rental properties, like deductions, depreciation, right? So
Mhm.
those losses we create are considered passive, which means it will always offset taxes from rental income, but it may not offset taxes from your W-2 income.
Mhm.
Unless if you're a real estate professional, which has a couple different roles. One of which is you have to actually spend more time in real estate than your job, and so just practically speaking, for our clients who work full time, it's difficult, if not impossible,
Yeah.
to also be a real estate professional yourself.
Yeah.
And this is where the short-term rental loophole comes in, because in those same exact facts, you're high income earner making over 150, working a W-2 job, real estate is your side hustle. But instead of investing in a long-term rental, you're investing in short-term rental like Airbnb. Well, now those losses does not always have to be limited. You may be able to use those to offset taxes from your W-2 income, even if you're not a real estate professional, even if real estate is just a side hustle for you.
Yeah.
And so this is where we see some pretty amazing results, because we have clients who are physicians, attorneys, other CPAs who are like, I love what I do. I don't want to stop doing what I do and do real estate full time, but I do want to use real estate to build wealth and also save taxes. And this is where like the short-term rental loophole will come into play.
Yeah. Yeah, the first time I heard about the loophole, it was a year that I had gotten, 60K in suspended losses from my long-term rentals, and I also had a tax bill of $60,000. And I was like, if only these two could just like talk to each other right now, I would not have this tax bill right now. And that was when somebody mentioned, well, you can buy a short-term rental. And I was like, what do you mean? And then I heard about it, but now delving into it, I know that it's not just owning the short-term rental. There are things you actually have to put in place. Now, can you talk about those a little bit?
Yeah, so for the short-term rental, if you want to use your tax losses to offset W-2 and other income, you have to meet what we call material participation hours. So this means like earning specific hours in that given year between January 1 and December 31st. And once you earn those hours, that means your rental losses can, talk to the other income and be able to offset each other. There are several different ways to qualify for material participation. I'll kind of go over three of them because
Yeah.
these three are like the vast majority of what we
Yes.
see. So the first one is you and your spouse, if you're married, spend at least 500 hours on those short-term rental properties. So this would be like furnishing it, getting it staged, dealing with the guests, dealing with contractors, dealing with cleaning crew, those types of kind of like management type of hours. So if you guys spend at least 500 hours, then you've met material participation. That's it. You're golden. They're now talking to each other. If you don't have 500 hours, another way to meet material participation is if you guys spend at least 100 hours, but nobody else spends more time than you. So in that example, it would be you spent 100 hours on your short-term rental and the cleaning crew only spent 80. The repair guys only spent 30, right? So you have at least 100, but more time than anyone
Anybody else?
else.
Yeah.
Yeah, and so this one works out really well. We see when our clients are investing in short-term rentals closer to the end of the year, like the fourth quarter, right? Because you're doing a lot of the work up front, staging it already, and the cleaning crew maybe doesn't have a lot of hours yet. And then the third way to qualify is you have any number of hours, but that's more than everybody else combined. So in an example, you have 60 hours, and if we add up the cleaning crew, the repair guys, and all those other people, they only have 40 together. You also would have met material participation. So any one of those three tests will allow you to use losses against your W-2 income. And what's really great about people who kind of start to build a real estate portfolio of short-term rentals is that you can actually combine your hours. So if I have 3 different short-term rentals, I can aggregate all of my hours together to meet that 500 requirement.
And very often when people think of the requirements, they think that it has to be 100 hours per property. But even the 100 hours across a few properties, as long as it's more than anybody else, still, even with across a few properties, you can still use a 100-hour test if it's still more than everybody else.
Yeah, exactly. But you just have to be careful though, when we say it's everybody else, it's not just everybody else on one property, it's everybody else on all the properties.
All the
And so what we see sometimes, it's like, I think just on the face of it, you would think the 100 hours is much easier to meet than 500, but it really depends on the property and what the taxpayer, the investor is doing, right? So sometimes the 500 hours could be better. And it's a year by year determination too. So maybe this year you bought a property at the end of the year, we're going to use the 100 hour because that's your only property and I'm just not going to get to 500. And then next year you try to meet the 500 because now I got a couple properties, right? So that's where the planning comes in.
That's actually what we did this year. Last year our goal was just 100. This year our goal was 5. Because well, I'm saying this year, I mean 2020 to 2023.
We're already 2 years ahead of what you're talking about, right?
Right. So now where do you see people making mistakes with trying to employ this strategy?
Yeah, I think one mistake
Or
area
misinformation.
is
Yeah.
Yeah. So, one thing is really important for people to understand because we talk about short-term rental, just like a loose term of short-term rentals. There's actually a definition in the tax world that a property is a short-term rental if the average guest stay is 7 days or less during that year. So it doesn't mean just because it's on Airbnb that you will qualify for this loophole. You do have to make sure the average guest stay is 7 days or less. So something really important to understand. But I think unfortunately, one of the biggest mistake areas we see with respect to short-term rentals is not made by the investor. It's actually made by CPAs or tax preparers who just don't understand short-term rentals.
Mm.
And, if you think about it, most CPAs, like a one-person CPA might have, 400 or 500 clients.
Mm-hmm.
And so a traditional CPA firm doesn't really specialize in anything, right? They'll have people who, do some Amazon sales and maybe some Airbnb and some long-term rentals and, maybe a restaurant. And so it's hard to find a CPA who specializes in real estate, first of all. And if you find someone who understands real estate, short-term rental is even more niched within the real estate realm. And I think this is the reason we get a lot of misinformation where people are telling clients and investors like, hey, you can't use losses because you're not a real estate professional, right? So I think if for our, for people who are with us, it's like, hey, if there's nothing you learn from everything we talk about today, the one statement is you do not have to be a real estate professional to use the short-term rental loophole. That
Yeah.
is why we call it a loophole, right? Because it's not real estate professional required.
If I could just like take that last like 10 seconds and just put it on a billboard somewhere, because I got on Facebook groups and I see well, I bought a short-term rental and I want to be a real estate professional. And I'm like, no.
Yes, yes. That's always the start of a conversation. And, I'm on social media a lot. For those of
Mhm.
you who want like bite-sized daily tax tips from me, you can follow me as Amanda Han CPA on
They're really
Instagram
good
and also
too.
on Facebook. Yeah, but whenever I post about short-term rentals, I always get these hate comments from investors and also from CPAs who are like, "No, you didn't talk about real estate professional." And I'm like, "I literally did." And I said, "You don't have to be."
Yeah, because when I first started investing and I heard about how you could be a real estate professional and be able to have your long-term rentals, offset your active income, I thought to myself, but wait, why would I want to do that? Right? Like
Mm,
at the time I was like, I'm doing this to not have to spend 750 hours on my property. So why would I then turn
mm,
around and try to become but anyway, at the time I was like, yeah, y'all can keep it. I'll pay the taxes. I'm good. Right. But then when I found the short-term rental strategy, I was like, okay, this makes more sense. 100 hours I can probably handle, right? As against
mhm.
all the other requirements for real estate professional status. Um,
Yeah.
a question popped in my head now, and I think I just lost it, but I'll remember it. Remember. Oh. This is one that actually comes up quite a bit, and it's the question of where is this filed? Is it Schedule C or Schedule E? This is one that comes up quite like a lot. I can't even tell you how often people ask me. Like,
Yeah, and it's like this gets into some like I don't want to date myself either, but Jerry Springer moments like between CPAs who maybe let's call it like MMF, where CPAs are very have very differing opinions about
yeah.
Schedule C or Schedule E. So for us, our firm's position is backed by court cases
Mhm.
that when you have a short-term rental investment where it's purely an Airbnb, like we're not offering services. You check
Right.
in, you check out, I'm going to clean the bed in between. Those are just going to be on Schedule E like any other rental real estate. Now, alternatively, if you're doing more than that, like you're offering an airport pickup and drop off, you are offering daily cleaning, they get to book stuff, other stuff through you, you're
Yeah.
kind of like concierge type of stuff,
Mhm.
then that gets more into like a hotel type of
Yeah.
business because you're doing more than just rental.
Mhm.
So those are times where it, will probably be more appropriate to be reported on a Schedule C. So
Yeah.
that's kind of how
Yeah.
we differentiate between the two. 99.9% of our clients are on Schedule E. I rarely have somebody who is so involved in services that it gets to that level.
Yeah.
The difference between the two is that when you are on a Schedule E, it's treated like any other long-term rental for income tax purposes.
Mhm.
And if it goes to a Schedule C, it's treated like an active business,
Mhm.
which means that if you have profit, like taxable profit, not only do you pay federal and state income taxes, you also have to pay an additional self-employment tax of up to 15%. So that could be, somewhat detrimental if you have very high profit.
Yeah. Yeah. Yeah, that it's definitely one that people have asked me multiple times, and I mean I always defer them, and I'm like, listen, talk to your accountant. But they're like, my accountant is trying to have me put it on Schedule C. I'm like, that sounds really wrong, but talk to your accountant still, because I
I
can't give you
know.
tax advice. I'm not your accountant. But I think
And I
somebody
think
said
the
it's supposed to be
issue,
E.
and I think the issue is that, I mean, again, CPAs have done argue both ways.
Mhm.
And I think the issue that we'll have is if your CPA puts it on a Schedule C, odds are the IRS is not going to argue for you to move it on a Schedule E because they're going to get more, pay more tax dollars,
They'll get more
right?
taxes. Yeah.
Yeah, exactly, going to pay more. And so if you put it on schedule, again, for us, we typically put it on Schedule E because we're not offering additional services. We are
Yeah.
not operating as a hotel, so it is a rental real estate activity.
And there was a flow chart that I saw about a year or two ago that basically calls what you just described substantial services, for the technical term for those who are looking at it. That all those like those extra little things, like, changing the sheets every single day or whatever while the guest is still there, buying them coffee every morning or whatever that is. Um, but as, but as long as they're just coming and leaving, then it falls under the whatever rental. Okay. So the what's it called? So there's this fading of bonus depreciation that's going on, and I guess we haven't even talked much about that. But I'm basically just like bringing up the things that people ask me about, and it's,
Yeah.
have you heard any rumblings? Have you heard any updates or plans for this fading of bonus depreciation? And if you want to talk
Yeah.
about
So bonus
what that is in the first place, yeah.
depreciation. Yeah. So basically for real estate investors, we always have the ability to do depreciation. And a couple of years ago, they came out with the concept of bonus depreciation. And bonus depreciation just means that if you have certain assets in your short-term rental, for example, that are 5-year, 7-year, or 15-year assets. So let's say I have some furniture that I was going to write off. Before, I would have had to write them off over 5 or 7 years. But with bonus depreciation, it just means that instead of waiting 5, 7, or 15 years, you can write them off faster. So several years ago, we had 100% bonus depreciation, where if something was going to be depreciated over 5 years, I'll take all of that immediately in the first year. And the same for the 7 to 15-year assets. And in 2023, we had 80% bonus depreciation, which means of this amount, I'll write off 80% immediately, and the remaining 20% I'll write off over 5 years or 17 years, depending on what the asset class is. In 2024, current rule is that it has phased out a little bit more to 60%. So properties and assets that you buy and put into service this year will be at 60% rather than 80% of last year. To your question about rumblings, yes, there's definitely rumblings about possibly bringing back 100% bonus depreciation. And the good news is that if it were to come true, it is possible, very possible, that they make it retroactive. So meaning for those of you who've purchased real estate and assets in 2023, thinking you are getting 80%, we may be able to get 100% bonus.
Okay.
Now I know your question is probably like, how likely? I don't
Hey,
know the
listen.
answer,
Of course.
unfortunately. But what we're telling clients today is like, the rumblings and the discussion of all this is the best we can hope for at the moment. Because for a long time, it was kind of, we think it's moved down, or maybe it's going to accelerate the rate at which they take it away. So I think we're on the right track to at least we're kind of now, or not we are, but Congress is now revisiting it to see if we need that to help stimulate the economy and just, have investors, promoting investors to do the right things and make more investments, basically.
Yeah. Yeah, that, I mean, if they bring that back and it's retroactive, that'll be so amazing. That'll be,
Oh
I'm
man, a lot
I'm
of our
just here
clients would
counting
be
the
so
dollars in my head
happy.
right now. That's a whole extra 20%. Amazing,
Yeah.
amazing, amazing.
Yeah. And I think it's people are like, no, they will never do that. But that's actually happened a lot of times before in the past, where when they bring something back, they do it retroactive because otherwise it's quite difficult, right? For them to be like, it was 100, then it was 80, and then now it was 100 again. And so
Right.
that's why sometimes they're like, let's just make it retroactive. It was, 100 all along or something like that.
So you mentioned very briefly about putting a property in service. Okay. One other question that I know I've come across has been somebody buys a property, it needs some work, And so they spend that first year doing the work on it, and then it goes in service after the like
Mm.
on January 1st, for example. Um, if that happened, let's say during this period, when should the cost segregation study, or when will that bonus depreciation number, should I say, be calculated? Will it be based on 2023's taxes, or will that be for 2024, since it was put technically in service this year, in spite of the fact that the property was
Mhm.
bought last year?
Yeah, great question. So placed in service for short-term rentals specifically usually means you have at least one set of guests who've checked in and out. And the
Okay.
reason we say that is because the definition of a short-term rental is the average guest stay is 7 days or less. So if I
Okay.
don't have any guest stays, it's difficult to make that argument, right? If the IRS said,
Mhm.
no, it's a long-term rental, you say, no, it's a short-term rental. Well, how do we prove that was a short-term?
Mm,
I mean, it's possible we say, hey, the following year was a short-term all year, but this is kind of like the risk tolerance level of that
yeah.
specific investor. And so, yeah, questions we have is like, hey, it's ready. I don't have furniture yet. Can I just have my cousin come and stay here for the night? Um, that usually doesn't work. We're trying to do tax planning in the spirit of the law. And the
Mhm.
law, I think, tells me that if your property is vacant and we got an air mattress in it, it's not really ready for Airbnb in terms of, the market, right? To
Mm,
market everybody else. So it's really key in making sure like try to do as much as you can
yeah.
to document it's actually rent placed into service. Um, and so what that means then is all the hours you incur. Let's say you bought something, you rehabbed it in 23, it's in
Mhm.
service in 24. The hours you spent on 2023 unfortunately doesn't roll forward. So January 1st, we start the hours
Start
again.
over.
We're at zero, we got
Yeah.
to earn our hours. But all those expenses you incurred in 2023, they absolutely carry over. So in
Okay.
2024, when it's in service, we do get to take depreciation deductions on all those 23 expenses that you've already.
Okay. 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 So those 2023 expenses then are a part of the total, I guess you probably say, basis that you
Yeah,
then
total cost
then
basis.
depreciate.
Yep. Yep. Got
That's
it.
that's good to know. Okay, okay. Because yeah, that is definitely one that has come up a number of times, and I'm like, that's a great question. Talk to your accountant.
Yeah.
That's probably one of my
Now you
favorite
know.
phrases, because I'm like, listen, go read Amanda's book, okay? And if you have more questions, go find her.
Yeah.
Um, okay, another one that also comes up pretty often is using a part of the property as a personal residence. So let's say you buy a property and you live in the main part of the house or something, but the basement you turn into a short-term rental. Does that, how does that affect or impact your ability to use that short-term rental loophole if it's a property that you live in a portion of?
Yeah, great question. And the answer will depend on how your property is actually laid out, believe it or not. So,
Mm,
for example, if I have a home that's a duplex, or like you said, it's a basement that has its own separate entrance and everything, then usually we treat those as two different properties. And so you
okay.
use the short-term rental loophole on the basement unit or on the other duplex, and that works out well, really, really well, especially because it's on site. Presumably you're doing a lot of the work and earning all those
Mhm.
hours. Kind of a similar twist to it. I have clients who say, hey, my home, I rent out this room as a short-term rental from time to time. That doesn't work as well because it's one dwelling. And so usually that's like, well, that's your home. You might be able to write off some expenses associated with that rental, those rental units and rental
Yeah,
days, but it's not as powerful as like a duplex where I rent out one unit. And the same goes for people. We have clients who are like, hey, I have a property in New York and I go to Florida in the winter, so I'm going to rent out my home in the winter. Does that count? Usually that's also, I mean, you can have expenses and all that, but you're limited in terms of
to those.
the tax deduction because it's still mainly your primary home that you're just
Yeah.
renting out, right? Sometime during the year.
And then I guess to kind of continue that thought, you lived in a house for like, 4 or 5 years. You said to move out and go somewhere else and turn that property into a short-term rental. Then does does that get you into the SDR, you know,
Yeah.
Yeah. Okay.
Definitely. Yeah, I love that. We have a lot of clients. I mean, that's actually a really great strategy because if you've lived there for at least 2 years,
Mhm.
and if you're married, you can eventually sell and get up to $500,000 of gains tax
Tax
free.
free.
And so one of the strategies is, okay, I've lived here, I'm going to move out and turn it into a rental. I think it's going to keep appreciating. And so I can rent it out. And as long as I sell within 3 years of moving out, I could still get the capital gains exclusion of up to 500,000. If my gain is beyond, right? Let's say if I sold, my gain is going to be like 700,000. What you can actually do is you can sell, exclude 500 of it, and the remaining 200,000, you can possibly consider a 1031 exchange to get that into your next deal. So it's a really great way to have, two strategies on top of each other where you have like tax-free money and also tax deferred money, and then
Hmm.
rolling all that into more real estate too.
So the 500,000 will be excluded, and then the 200 gets rolled over. Um, so I guess if you sold that property, I'm trying to think of how the mechanics will work in terms of having that like intermediary person in there. So they can give you the 500 to go do your thing, but they'll have to roll over
Yeah.
the everything else that's left behind. Hmm.
Yeah, yeah. And it's it's definitely doable, like with you and your CPA and your intermediate. What I would tell
Yeah.
people is if you are turning a primary home into a rental, the key is to put something on your calendar, right? Because we said that, sell within 3 years. So in
Mhm.
about 2.5 years, you want something popping up on your calendar that says, let me think about if I want to sell, right? You don't have to sell. There's nothing that says you
Right.
have to.
Hmm.
But at
Hmm.
least we want a reminder, like, hey, it's been some time. Let's see if it makes sense to sell this or keep holding on to it. And then that's when you'll do the analysis, because at that time we say, what's the gain? Do you have other losses? What's going on? Do we need to even do a 1031 exchange? Sometimes you do, but sometimes you don't.
Hmm. Okay. And then now, even now to get into just a little bit of nitty-gritty, like short-term rental, financial management, and bookkeeping stuff. Um, are there certain practices that you see hosts either doing or you think that they should be doing regarding their bookkeeping? Are there any things that you see that I see people leaving out or needing to keep track of, for example?
I mean, short-term rental, like bookkeeping wise, it's a little bit more involved, right, than
Yeah.
long-term rental properties because we do have a lot more expenses kind of coming in and out with respect to keeping it, maintained and stocking all the supplies and all that.
Mhm.
So really important to make sure you have a system of tracking those expenses, whether it's, using a software like QuickBooks or an Excel format, but just having a system like, hey, whenever I have expenses, I'm going to pay with this credit card or this bank account, and the receipts will go into this folder so that me or my bookkeeper or my assistant knows where to get that information. Because there's larger volume, if you miss doing that for a couple months, then odds are you've maybe lost something. What
It's
was that? That
January.
was
It's
like
that
you're
time of the
talking to.
year.
Oh man. Okay, so that's what you don't want to do. You don't want to say it's January, it's that time of the year, because if you would have been doing it,
One
if you
day
were
I'll
doing it
learn that.
all,
I'll learn that lesson one
yeah,
day. Okay.
yes. So one day is today. You're gonna clean up 2023 and you're gonna start 2024. It's gonna be good. And so yeah, because there's so much volume, you want to make
Yeah.
sure you have a system to do it, and you don't have to worry about this January fatigue that's already going on in your mind. I do think for those of you who have property managers
Mhm.
dealing with your short-term rentals, one of the common misconceptions is people think I have a property manager, I don't have to track anything.
Mm.
Well, keep in mind that your property manager is not tracking a lot of your overhead costs. So
Mhm.
your cost to join a membership, your cost to go to a conference, your cost to pay a CPA, your attorney, entity formation. And so it's still important for you to track all those business expenses. And so don't think bookkeeping doesn't apply to you just because you have a property manager, because odds are you're missing out on a lot of deductions.
Yeah. And sometimes at this point, people will ask, "Oh, what are things that I can deduct?" In my head, it's literally everything. Like if it has after I read your book, I mean, that basically
Yeah.
told me like literally everything, right? Like as long as it has to do
Yeah.
with my
Is that what I
business.
said?
No, that's not what you said.
Yes.
That's what my head heard.
That's
Okay.
what you read. Yeah, yeah. So yeah, what can I deduct? Yes. I mean, so I would kind of just rephrase it, right? You can deduct everything that is business
Business
related.
related. Yes.
So when you're spending money on something, ask yourself this simple question. Is this something that's necessary for my real estate business? And is it something that an ordinary investor would have and need? So that's what they're looking for, ordinary and necessary. And if you don't know the answer to that, right, because we all have kind of wacky expenses from time to time, that's what your tax advisor is there to do, right? You run it by them and say, hey, is this something that's tax deductible? And, or a better question is, how can this be tax deductible, right? Maybe, I'm going to Florida. I want to go to Florida this summer. Is it a tax deduction? No, because I'm going to Orlando. I'm going to Disney World. Well, how can it be a tax deduction? Well, are there real estate conferences you can attend? Do you have properties there? Do you want to buy properties there? How can we create the facts so that you do the right things
Yeah.
so that you can deduct that trip?
That was the tip you gave in that book that stuck with me the most. And it was that
Oh,
strategy of basically planning your trip with meetings straddling a weekend. And I was like, that is so genius. I read this book probably like maybe 4 or 5 years ago. So guys, when I tell you it is a good book, and she has part two, but part one is still golden.
yeah.
Yeah, no, that hey, listen, I can't say I really liked taxes before real estate. Like back in, I don't know, 2010, taxes was like, wait, what? What's that? But it was tax-free wealth was the first one, and then yours was the second. And yeah, since then, yeah.
Now you love it.
Yes. Getting those checks back are, I mean, it's pretty good to get, that nice huge fat check on my birthday. So this past year, my check came in on my birthday, so it couldn't have been, and it was from the short-term rental um loophole, whatever, that we had a nice chunky refund for the first time in a while. Oh, it
Yeah.
felt so good.
Nice.
It
Take a
arrived
picture
on my
with it.
birthday, so it did. Okay, so are there any other, tips, tricks, techniques, or whatever that you would like to share, that you think are related to short-term rentals that we haven't touched on?
Yeah, I just think that one of the most common mistakes I see people make is thinking that the person preparing their tax returns is also doing tax
Oh,
planning for
yes.
them. And the reality is that's just not the case. How do I know? Because I'm also a CPA. When I'm preparing someone's tax return, I'm not necessarily, I'm focused on making sure I report the best way possible for last year. I have to be in a different frame of mind when we have to take time to talk about this year and beyond for planning. And so definitely take some time, to talk to your tax person, not when you're filing last year's returns, but a separate time when you talk to them
Conversation, yeah.
about planning. And if they don't do planning, you can always seek the advice of another person or company to help you with planning. We have a lot of clients that want to work with their local CPA, or like their CPA is their dad or their father-in-law, but they come to us for the planning piece of it
Okay.
because they're not getting that right with whoever's filing their returns. And so really important, and if we're early on in the year is when there's like endless opportunities for us to work with, especially in the short-term rental space. What always happens to me is around October, November, December is when I get new clients are like, I want to do the short-term rental loophole. How do I do the short-term rental loophole? And although it's possible, sometimes it's very difficult because you got to find the property, close, stage, get it rented out all in a 2-3 months period. And that's just like a lot of added stress, right? So that's one tip. Let's start this early so we
Yeah.
don't have to have the same conversation in December.
Yeah. That's golden, golden. I mean, I had no doubt that this was gonna be just a golden interview, and you've definitely brought the gems. How can people find you, Amanda? Where, like, social media, how can they find you?
Yeah, I think if you're brand new to like, or if just a lot, some of the things we talked about, you're is new to you, or you don't really know everything about it. The best place to go is my company website. That is KeystoneCPA.com,
Mhm.
and we have a free tax savings toolkit where we talk about legal entity structurings, how do you maximize your deductions, and we have a whole section. I think it's like 30 pages in our free download resource that talks specifically about the short-term rental loophole.
Oh, I love it.
So definitely check that out. It's KeystoneCPA.com. Like I said earlier, if you're looking for daily tax tips, like small chunks of it, because you don't want to read a book, the best place to find me is on Instagram as Amanda Han CPA.
Amazing. And what's the title of your book? I don't think we even mentioned the title of the book. We
Oh, we
just raved
didn't,
about it.
huh?
We just like raved about it and was like, you know what,
We're
guys,
just
you just
like,
have to just imagine the name of the book.
I know, like, where I don't even have a copy here. Okay,
Um,
so the name of the book, so we have two volumes. The first one, for those of you starting out with taxes, is Tax Strategies for the Savvy Real Estate Investor.
yes.
Um, and our second book is called the book on Advanced Tax Strategies for a Real Estate Investor. So definitely start with the first one,
Yes.
if all this is sort of new to you, and you can find it on Amazon, Bigger Pockets, Barnes and Nobles, pretty much anywhere books are sold.
Amazing, amazing. Thanks again, Amanda, for joining us here on STR Kickstarter. Guys, KeystoneCPA.com, tax strategies for the savvy real estate investor. That book series is a must-have for anybody. I may even have one near me. For anyone who's investing in real estate. Thanks again so much for coming on. I really appreciate your time.
Yeah, thanks for having me.
Pleasure.